Mr. Chairman, thank you so much. I want to talk about call reports, and most of my comments are going to really focus on the impact of all of these rules on small financial institutions. And so I want to begin by saying there's little doubt that clear and consistent capital and liquidity requirements are an essential part of a strong banking system. I think that's something we can all agree on, and it's absolutely the best line of defense against future bailouts. But small businesses and small banks, like the majority of banks in my state, have great concerns about the complex reporting requirements referenced in Ms. Rainey's testimony, and particularly because they are costly, time-consuming, and confusing, especially for smaller institutions. When you take that into account with a variety of other rules and regulations that small banks are now implementing that are unrelated to Basel, the fact that the smaller banks don't have time and resources to coordinate and implement these rules. And so I guess I'm going to ask Ms. Taub, what's your reaction to the small bank concerns about the increased reporting requirements, and is there a path forward as you see it to address what I believe is legitimate concerns?
Thank you for the question. The way I'd like to respond to it is to talk about that issue of amnesia again. I take a different lesson than Mr. Abernathy does about the savings and loan crisis. He said, and as you know, that was small and regional banks that were affected. He suggested that the lesson of that crisis was that net worth or leverage didn't really hold up. But that's actually not what happened there. The savings and loans faced an interest rate shock. Then they were facing competition for deposits from money market funds. And as a result of that, they managed to achieve massive deregulation for the asset side of their balance sheet. And in fact, it was because they were struggling in that environment that they got special accounting treatment. Instead of GAAP, it was called RAP, and they were able to kind of monkey with their net worth. So I would point out that it's not just large banks that can cause massive crises that result in taxpayer-funded bailouts, but also correlated bad practices at small institutions.
I think it would be a little bit of an exaggeration to say the savings and loan crisis had the same consequences and result as the crisis in 2008. Ms. Rainey, can you give us some feedback on your relationships with financial regulators, whether you believe that generally there's a level of responsiveness to a lot of the concerns that I hear from my local community bankers, and what can we do to enhance that dialogue?
Thank you. Yes, I feel, and I've had the opportunity to work, whether it's on advisory councils or committees, to engage in conversation, and I think those have been productive. I think as we talk about some of the specific examples here today, whether it's call report reform or some of the pieces within the Basel rules, this exemption for community banks, so much of it also requires legislative action. And so I think in a best case scenario, to be able to move forward in these dialogues, both with the regulators as well with Congress, to feel how we make some of these things happen and avail all tools possible to provide a best case scenario.
Another issue that frequently comes up is the issue of distributions from Subchapter S and taxability of those distributions, or the lack of distributions, but still incurring a tax liability, which can put quite a strain on a small organization, certainly on a small community family-owned bank. Can you walk me through how that requirement will be phased over the next few years, see what major risks all of that provides to community banks, and offer maybe some suggestion on how we can be more responsive to the legitimate concerns of the Subchapter S issue?
This is a significant and very personal issue for us. Now, while I would hope to never find myself in a situation like that, the pure fact that our shareholders, family-owned organization, would be responsible for the earnings of the association of the organization and to pay them out of tax is very concerning. And I would draw your attention to an example of C corporation banks. Even if they were in a scenario below the well-capitalized limits, they would still be able to pay the taxes on the income of the organization. So why would we create a different scenario purely for sub-S organizations? And so as we look at this, I think there's a simple solution situation in that we allow, even if we were in that capital conservation buffer period, the opportunity for the bank to distribute up to 40% of its earnings to pay the associated tax and allow for those shareholders to take care of the liability.
So not avoiding the liability, but making sure that the assets are there rather than personal assets to pay for profitability of the bank. I'm out of time. I'll submit the rest of my questions for the record.